Hello there, this is another video. This is me, Ademola Oladoja from the Forex Trading Inner Circle, and this video is a continuation of the previous video on how Forex trading works. This is video 2, and in this video we're talking about how profits are calculated in Forex trading. We have people who have been trading for so long a time and they don't understand the system of how these profits are being calculated. You see, not knowing how the profits are being calculated can lead you to make some mistakes on your trading, which can expose you to more of risk and expose you to some unnecessary losses. So I'm doing this video so that you can understand how these profits are being calculated. In my previous video where I used the Bureau de Change to explain how you can buy low and sell high, or sell high and buy low, I explained that in Forex, if the price is going down, you are making money. The price is going up, you are making money. What you are after is movement. If the price is not moving, that's when it's not a good thing for Forex. But when the price is moving, you are making money. So the difference between the Bureau de Change that I use as an example and the real life Forex trading market is that in a Bureau de Change, you go to the office of the Bureau de Change and you do what? You present Naira, for example, and they give you dollar physically. You hold the Naira in your hand and you buy the dollar physically. But in Forex trading, you are not actually buying the dollar. You are not actually holding the dollar in your hand. You are not even transferring it to your account. You are not buying dollar. For instance, you say you are buying the GBP USD, buying GBP and selling USD. You are not actually buying the GBP and you are not actually selling the USD. Buying the GBP, put it in your account and wait and sell it again. No, that's not what you're actually doing. What you're doing, there are different terms that are used in describing this. Some people call it spread betting. I want you to Google spread betting. Well, this is not a gambling escapade, but there's some languages. Languages are very funny, but that's what they call it, spread betting. Another set of people call it CFD, commission for difference. So you are not actually buying the dollar or you are selling the dollar. No, you are bidding on a particular price in relation to time. Well, let me show you that so that you can understand what I'm saying much better. Now, this is my chart. This is my chart on MetaTrader Client Terminal, and I am in this pair. This pair is called Euro Card. That is Euro versus Canadian dollar. So here, look at the orders. I placed a buy here. And you hear, what do you see here? 0.02. And this is the ticket number for the order. This is the ticket order number. And you can see these green lines. You can see red lines, another green, another red here and red here. Now, these are lines that are showing me my entry points, my stop loss, my take profit. Those are the meaning of those lines. But what I'm going to explain to you in this video is how are these profits being calculated. Now look at the right side, the extreme right side here. What do you see? 1.56144, isn't it? You see it has changed. 1.56142 now. Well, this is how the prices change in the live Forex market. It can even be faster than this. I'm recording this at about 6:37 in the morning, so volatility has not really picked up. What I mean by volatility is the speed of the movement of price. It has not really increased. So this is it. This is the current price at this very second, at this white line that you are seeing. Now you can see another one, 1.55930, another one, 1.55685. Now what you are doing here is you are trying to take very fractional amounts of movement and bring profit out of it. Now let me explain how this fractional amount of movements can bring you profit. We're going to do some calculations here. I love doing this calculation so that you can understand it much better. I want you to bring out your pen and your paper. This is going to be really interesting. If you're on a computer, you can bring out your calculator. If you have a smartphone, you can use the calculator on your smartphone. But if not, no problem. You can still tag along with the video. Now, here we have 1.56135, right? 1.56135. That is how much we have. It has changed to 136, but no worries. Just leave it like that. Now, that is the current price while we wrote it down. Now, let's assume that the price now moved from 1.5 56135 to 1.56139. So you see, between 1.56135 and 1.56139, the difference between the two is 0.00, are you getting me? 004. Are you getting me now? Now, that is called a fractional pip. Why did I call it a fractional pip? That is, we have 1, 2, 3, 4, 5. 5 digits after the decimal point is a fractional pip. Because most brokers are using fractional pip pricing now. That's why I'm using this as an example. That's a fractional pip. Now, let's do another calculation now. Let's do a calculation based on 1.56135 and 1.56175. Are you getting it now? Okay, so what is the difference between the two? So we have here the difference between the two is 0.0040. So this is called 4 pips. It's not 40 pips, it's called 4 pips. If you are using 5, if you are seeing 5 digits after the decimal point, this is 4 pips. If you are seeing 4 digits after the decimal point, it's 4 pips. So if you are seeing 5 digits after the decimal point, it's also 4 pips. Are you getting me now? Then if you see 0.00045, that is 4.5 pips. That's why they call it fractional pip pricing. If you see 0.00045, that is 4.5 pips. 4.5 pips. That is how much difference it is. Now, 1 pip. You can imagine 1 pip now. Okay, let's even use this 4 pips as an example. How much value can I attain by trading and making 4 pips in profit? Let's do a quick calculation. Let's assume that you are trading with $1,000. So this is $1,000, right? Good. $1,000 multiplied by 0.00040, which is 4 pips, not 40 pips. So are you ready? I'm going to bring out my calculator so we can do it together. So here we go. This is my calculator, and we're going to do the calculation. So I'm saying that $1,000, $1,000 multiplied by 0.00040. So how much profit? 4 pips. How much profit are we making? You are making $0.4. It's not even up to, it's not up to what can we call it? It's not up to 50 cents. This is 40 cents. $0.4 is the same thing as 40 cents. Are you getting me now? So that is how much profit you make. 40 cents out of $1,000. That is small, because which means before you can make a substantial amount, say $100, you will make a lot of pips, which is a Herculean job, you know. But to make things easy for you, to make it easier for you to make profit in Forex, you need a broker. It is the Forex broker that supplies you with the MetaTrader client terminal. You know, the application I showed you earlier. You see, this MetaTrader client terminal is supplied by the Forex broker. Now, another thing the Forex broker will also give you is called leverage. Now, how does this leverage work? The leverage is a multiplication of your margin deposit by a particular value. Now, let's give an example now. Let's say I'm using a leverage ratio of ratio 1 to 100. So, it means my $1,000 will be multiplied by 100. So, instead of me trading with $1,000, I'm trading with $100,000. Are you getting the idea now? So, this is how it works. They give you $100,000 to trade, but immediately you have lost $1,000. Game over. They will close the trade because they don't want you to lose more than your margin deposit. That's why they call it margin deposit, and they call it leverage. Your margin deposit is like an insurance that, okay, give us this money so that we'll know that you will not run away when losses comes. This is your margin deposit. But if you are losing in your trade and you lose the exact amount of your margin deposit, that means we will cut you out of the market so that you will not lose more than what you put in the market. Are you getting? Because before, in forex trading, there's something called margin call. They will give you a telephone call that you have lost more than what you have put in the forex market, so go and find the money. So you'll be in debt. So, but to curb that, to protect you, you put the margin deposit, and when you lose when you lose up to the money you put into forex, then you are closed out of the market. So let's continue the explanation. So we multiply our $1,000 by 100, right? Okay. So here we are again at the drawing board. So the same amount that we did now, the same calculation we did earlier, which is 0.00040 multiplied by 1,000. Let's redo it on the 100,000 now. If we made 4 pips on the 100,000 trading leverage. Ready? Okay, let's do it now. I'm going to clear this off and say 0.00040, which is the same thing as 4 pips. Don't forget, I said don't remember. It's the same thing as 4 pips, not 40 pips. This is 4 pips. So what we're going to do is we multiply it by times 100,000. 1, 2, 3. So what is the answer? So we have $40. Isn't that better? That is much better. We have $40. You see, this is a better way of making money in forex. That's why you needed the leverage, because a lot of people don't understand leverage. They'll just be hearing a leverage ratio of ratio 1 to 10, ratio 1 to 100, ratio 1 to 500. Do you know there are brokers that give you leverage ratio of ratio 1 to 1,000? Let's do the quick calculation. If you are giving a leverage ratio of ratio 1 to 1,000, do you know what that means? It means your $1,000 will be multiplied with another $1,000, making what? Making $1 million. Let's quickly do a calculation on that. They give you a leverage ratio of ratio 1 to 1,000. So what would that be? That would be 1, 1, 2, 3. That's what your 1,000 multiplied by another 1, 1, 2, 3. 1,000. That's 1 million. So let's multiply it by the pip value now. Multiplied by what? 0.00040. What's the answer? $400. You're making money. But it has a good side, it has a bad side. It's a double-edged sword. This leverage I'm explaining here is a double-edged sword, and you don't want to be on the other side of that sword. Now let me give you a quick explanation on how these profits are being calculated more. In trading forex, there's something called volume, or called lots. I'm going to show you how that works in the MetaTrader client terminal just in a minute. So this is the MetaTrader client terminal again. You see here, we have here new order, right? If I click on new order, here we are. So you see here the wrote volume. Now if I come here and I select 1.0 as my volume, what will happen is that each pip, remember how I explained pip? I've explained pip earlier. Each pip you make is equivalent to $10. You make 1 pip, you have made $10. 2 pips, another $10, making $20. So that's the reason why our 4 pips was $40 when we did the calculation. Are you getting me? When we did the calculation using the leverage ratio of ratio 1 to 100, our 4 pips was $40. Good. If you want to use another volume, you can decide to use 0.1. It's not in the list, but you can type it manually. Just type 0.1. Now, if you put 0.1 as your volume, each pip will be $1. So if you make 4 pips, you are making $4. Are you getting the explanation? 4 pips makes $4. That's if you are using 0.1. There's another one here called 0.01. This one pip is equal to 10 cents. If you make 4 pips, you have made 40 cents. Are you getting it now? Now, as it is when you are making money, the same thing happens when you are losing money. So imagine you use a lot size of 1.0 on a $1,000 account. You type inside this box 1.0 on a $1,000 account, meaning that 1 pip is equal to $10. So, do you know what this means? Immediately you lose 100 pips. That is a bye-bye. That is game over. Because if you lose 100 pips on a $1,000 account, you have lost all your money. That's the reason why risk management is important. Well, I will bring the video to a close at this level because I think I have explained some things. If you like this video, in fact, I did this video for the purpose of those who don't believe in online classes. I don't believe in online classes. I prefer coming to your office. I will sit down. You will sit down. I'll be teaching you. You'll be teaching me how to trade Forex. The problem is that, one, I don't have the time. How many people do I want to sit down and teach one after the other? That's one. Then two, it will benefit you more to take my online class than saying you want to travel all the way from wherever you are to Nigeria, to Abuja, and say you want to come and see me at the office. So instead of, finding an excuse not to learn what you're supposed to learn on time, you can take our online class. So when you are ready, just send me a WhatsApp message to 0818-5990-414 if you are in Nigeria. If you are outside Nigeria, you can just add a +234 and you put 818-599-04 then 14. That's how to reach me on WhatsApp. When you do that, I will send a book to you. That book is just 18 pages, straight to the point. It won't take your time. That book tells you the truth of Forex trading. I don't know what you have heard about Forex before you met me, but this book will tell you the point blank truth. So when you send me the Hello Forex message on WhatsApp, I'll send the book to you. Then you read it, you get back to me, then we get it going together. So if you have questions, you can also send me WhatsApp message through the same number. I'll be very happy to answer your questions. So thank you for watching this video to the end. I hope I was able to give you some clues about how leveraging works and how profits are being calculated in Forex trading. So have a wonderful day and bye.